with timely information and training each month on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. This month we are presenting the top 5 life insurance plans every insurance and financial advisor must know. With me today are Nick Palivita and Max Couliette. Nick is CEO of National Pension Partners, adjunct professor of the Graduate Tax Program at Northeastern University, and a member of the Florida Bar and American Bar Association. He is admitted to practice in the state of Florida, the U.S. Tax Court, the Ninth Circuit Court of Appeals, the 11th Circuit Court of Appeals, and the Supreme Court of the United States. His wealth of knowledge and experience in the fields of advanced tax, estate, and pension planning span more than 30 years, and he has presented continuing education programs and seminars across the country. Nick has also been widely published, including the definitive guide, Defined Benefit Pension Plans, the Complete Handbook. And Max Couliette, as president of National Pension Partners, Max brings more than 30 years of retirement planning experience to the team. He also owns Intermountain Financial Education, which provides licensed continuing education to CPAs, insurance producers, and other financial professionals. In addition, Max is president and managing principal of One Financial Advisors, a comprehensive financial services firm helping clients to maximize their wealth, retirement security, and financial protection. Max has extensive experience working with individuals, business owners, and executives, as well as managing the training and development of other financial professionals. Today, Nick and Max will discuss the features and benefits of each of the top 5 plans and will provide in-depth information concerning important rules that you need to know. During the presentation and question and answer session, you may type questions in the question box on the right side of your screen. Questions will be answered during the question and answer session at the end of the program. So let's begin. Nick and Max, I'll turn the discussion to you.
Well, thank you, Brendan, and if you can move to the next slide, but thank you for that very kind introduction. So after we're just going to get started here on some of the top 5 life insurance plans every financial advisor must know. Just remember, this is believed to provide accurate and authoritative information on the subject matter. However, it's not guaranteed. And it's the understanding that NAFA and National Pension Partners is not rendering legal, accounting, tax, or other professional service. If legal advice or other expert assistance is required, the service of competent professionals should be sought. So let's take a look at what the next slide says, which should be a little bit about myself. And Brendan went over it quite completely. I've been practicing law for now more than 30 years, admitted before the U.S. Supreme Court, Tax Court, went to South Florida, Miami, Denver for my MBA, JD, and LLM. And I actually did a lot of work with, I would say, very interesting people throughout my career, including the founding family of Coca-Cola, the founder of Dunkin' Donuts, President Philip Morris, President of Kimberly-Clark. Currently, I am an adjunct professor for the Masters in Trust and Wealth Management program at Campbell University here in North Carolina, where I'm coming from. And also for the last 5 years, and even this year, I'm the adjunct professor for the Graduate Tax Program at Northeastern University in Boston, and I work with National Pension Partners out of the Salt Lake City area. So let's go to the next slide, and we'll talk a little bit to Max.
Well, I'm Max Couliette, and I've been in the business for 31 years. Nick and I have worked together since about 2004, I believe it is, and we have worked intimately in, specifically with defined benefit and fully insured defined benefit plans. And we've, between us, done a large number of those. I have a lot of experience in the financial planning industry. I started my career as a CFP, and many years ago, over 31 years, I guess it is now, we have worked with a number of different companies, the advanced underwriting departments, helping them with their defined benefit, fully insured pension plan marketplace. And I also teach a lot of CE for insurance advisors, CFPs, CPAs, and CLE for their attorneys here in the state of Utah, the Intermountain region, and Colorado. I've done a number of those courses. So between Nick and I, we've done a lot of this presenting, and we have an interesting background and experience pool to draw from to talk about some of these topics that I think are of interest to most insurance advisors today.
Yeah, and if we go to the next slide, and first of all, we want to just do a brief introduction before we hit the countdown. Professional qualifications and designation help sales. So if you're in the retail area, just remember, and this was a survey done by the MDRT in 2009, experts, in other words, a CFP, a CLU, CHFC, have 40% more in annual revenue, but just make sure the designations are legitimate, such as CFP, CLU, LUTCF. And there's possible civil litigation against certain designations, but what we're doing as part of NAIFA is we're encouraging people to get educated in this area. It's a fascinating area, and if you haven't got your designations yet, talk to the people at NAIFA to get them. Let's go look at the next slide. We still have some more introductions, and here's something very interesting that we found out in risk management, the value of a life. Well, most people today are underinsured. Remember, there's no legal requirement that says you have to carry a life insurance policy. You have to carry a policy for your car, but not your life insurance. So let's just take a look briefly in a low interest rate environment, what it costs to replace a $46,000 a year income at age 40. Now, this is the average person in the United States today. Okay, they need approximately $1 million to replace $46,000. And these numbers become important because if you become a professional and you're making $138,000, which is what the average professional makes today, they need $3 million in life insurance. And I can tell you in that market space we do a lot of work with, they don't have $3 million of life insurance to replace that income. Medical doctors, and we're talking primary care because specialists make more than this, they average about $231,000, and they need $5 million to replace that income. So we're working right now in a space which I call the underinsured market space, which is most workers today. Let's go take a look at the next slide. So why do we do life insurance plans? Well, as opposed to, well, we put it in a mutual fund. Well, according to Jeremy Grantham, a veteran at GMO, his best guess is in the next several years that the stock market is basically overpriced. He said that 75% to 125% at the end of March, and he believes it'll average about 2% over the next 7 years, which is not very good. Warren Buffett says ignore Grantham at your own risk. So one reason you want to look at these fixed products, which we're going to look at today, the guaranteed fixed products, is because they provide that stability against the potential huge drop in the stock market, which for those who have been around in 2008, we saw that 37% loss. Let's go take a look at the next slide. Okay, so now we're going to get to the countdown. The top 5 life insurance plans every financial planner must know. Let's go to number 5 on our countdown. For the countdown, let's look at number 5, Brendan, the next slide. Okay? The max-funded non-MEC IUL or VUL. What is that? Okay? And it can be a max-funded non-MEC whole life. Right? This plan is so popular that in Palm Beach, Florida, they call it the 720 plan. Okay? And here's the history of this plan. We have to go back into the 80s, which many of you who are out there listening worked in this in the 80s and the 70s, and you'll recall one promoter was pushing single premium whole life and literally putting hundreds of millions of dollars into single premium whole life products because there was no mortality risk. As the money all went to the insurance company, there was really no death benefit, and it earned the portfolio rate of the insurance company. It was a great deal for the customer who bought that. Well, like every great deal, then Congress gets wind of these single premium whole lives, and they passed a law. I remember when this happened. I was working in this industry back then. They passed TAMRA, the Technical and Miscellaneous Revenue Act of 1988, and they said, you can't do this anymore. You have to have a risk corridor, otherwise it becomes a modified endowment contract and the distributions are taxable. So people thought, well, I guess we can't do single premium whole life. But what you can do even today is fund up to the limits. So the thing is, the plan has a maximum funded amount to provide very decent investment returns. And remember, if it's a IUL or a whole life product, it's not a security. The minute you move into variable, it becomes a security, and you may not have those guarantees, and we're not here to talk about securities. Okay, but this is a plan, and let's go to the next slide, that you definitely need to know about, and the insurance companies you work with should be educating you in this area. However, we've seen is a lot of companies aren't providing the education in this area, which is one reason for the NACIL. Okay, because this is a very powerful tool. I remember we did literally millions of dollars worth in the MECs funded non-MEC. The policy never becomes a modified endowment contract. Your insurance company will work with you to make sure it never does that. So the cash value builds up tax-free, and the distributions go out tax-free. Realize there are mortality charges, and you have to make sure there's a need for a death benefit. Okay, don't want to do, as a lawyer I tell you, bad facts make bad law. If you go see a person who's single, has no children, has no significant others, doesn't care about anybody, and you say you should buy this as an investment, you probably went to the wrong person, and you're going to have it handed to you by a court. However, if you document your files and say, well, how much insurance do you have? You're making $46,000, you need $1 million to replace it. Then you may want to look at this because it performs two functions. One, gives them the death benefit to replace that income. We already know what it is, $1 million, $3 million, $5 million. And at the same time, it provides an investment vehicle for them that later on they can take out tax-free. So hence, every case is different, and it's something you want in your toolbox. MEC-funded, non-MEC, IUL, or VUL. Okay, so let's go to the next slide. Suitability, and that's what I'm talking about. The person who doesn't care about life insurance and hates everybody, not suitable. Person who married, very suitable. Married with children, even more suitable. People that need death benefits. And if they don't have enough death benefits to replace those lifetime incomes, it's something you do need to talk to them about. But also, one of the big advantages insurance has even today, builds up tax-free inside the policy and then it's distributed on a tax-free basis. So remember, consult your insurance company provider. Each company has a different non-MEC design. Let's go look at the next slide.
Now we get to countdown number 4, and if we hit the next slide, we really get into the meat of this topic, because this is the life insurance contract and the living benefits. So Brandon, if you can go to the next slide there. And in that contract, a lot of companies are coming out with the life insurance contract where they don't charge for that rider for the living benefits. And what are those living benefits? Well, long-term care, critical illness, terminal illness benefits. And that's what folks are looking for in today's world. There is more and more information out there on these policies. And part of it is you've got 10,000 people a day that are turning age 65. 40% of those people are going to suffer from some form of dementia based on recent studies. You know, I usually tell people that if you've got a husband and wife age 65 today, the risk is almost 90% that one of those will need some kind of either assisted care, in-home health care, or something. Now, when you get into these contracts, if you go to the next page, yes, they're hot in the industry, and it's probably the hottest thing around today, and I don't see a lot of agents and advisors talking about this. But they should be. And why should they be talking about it? Well, it's really pretty simple. The market exists, and people are there waiting for the benefit. And you have an opportunity to take a look at existing contracts and basically determine whether that old contract still makes sense. Because if you have the ability to pick up the old contract, but maybe by making some changes, add the new contract to their insurance portfolio, you now pick up these living benefits. And there are some that are HIPAA qualified and Pension Protection Act qualified, and that can make a big difference. So you need to make sure that they're suitable. So if you go to the next slide, I'll kind of address that a little bit more, because when you get into these policies, you know, these policies, a lot of them didn't exist until about 5 years ago. And people should consider upgrading. And producers need to be doing reviews with their clients, because this is a great opportunity to bring something new to the client and set up some potential sales. Now, here's why these are valuable. I've been in this business a long time. I dealt with my parents many, many years ago. I'm the baby in my family, but I had to deal with them on a issue related to care. And so I started selling long-term care insurance. Well, there was a problem I always ran into with long-term care insurance. I constantly heard from people, geez, I don't want that stuff. I'm going to fight tooth and nail to never use it and hope and pray I don't. And if I never use it, I feel like I've thrown all that money down a rat hole. And if I use it, well, then I've lost the battle anyway. And so they felt like it was a lose-lose versus a win-win. If we use the insurance contract this way, they can pick up those benefits. So if you go to the next slide, you can kind of see, the industry's created these policies with riders or specific policies for this. There's 2 or 3 carriers that have a specific policy for this, where they provide living benefits for long-term care, for disabilities, for chronic illness, and it's taken from the face amount of the policy. Some of them allow riders for continuation of benefit or extending the benefit. And so what this has done now is you now have a policy that can be used for long-term care that's outside of the traditional health-based long-term care that provides the death benefit. So what happens is, in essence, if they've changed their mind down the road, they can cash the policy in and get the cash value out if they so desire. Or 2, if they need care, they can exercise the options on the care benefits or the long-term care, disability, or chronic illness benefits. And 3, if they win that battle and what they hoped and prayed for really happens, they don't have to use it, they get the benefits. Their family will get the benefits in the form of a death benefit. So if you go to the next slide again, the insurance company, each policy is different. You have to look at those. But if you're not familiar with these, you need to be looking at them as an advisor. Coverage can vary company to company. The insurance company, has typically a lot of options available. And some companies are actually allowing you to take that old contract and replace it with something that has that. That may be advantageous for your client. So this requires some of your time to take a look at, to make sure it fits for what your client needs. Ultimately, my philosophy is to make sure that you're dealing with the client. And also keep in mind, one size does not fit all. And I sometimes tease Nick that I have absolutely no doubt he could put on my suit coat. May look a little funny on him, but I would probably be very challenged to get into his. And so if you remember that thought of one size doesn't fit all, you've got to look at each client as an individual and bring these topics up with these products. I think you can provide a great service to your client. Nick?
Yes, let's move to the next slide because we're going to the countdown number 3. But what Max said, I think, is one of the most exciting things in the industry that's quietly being done is living benefits from your death benefit. I mean, most of the companies do that as a rider with no additional charge. And now if you get into trouble, chronic illness, terminal illness, or you have to go to long-term care, you can start pulling off the death benefit. I mean, it's just a great, great product to have out there, and everybody here needs to know about. Clients, many of your clients, almost all of ours, need to have their policies, if they can, upgraded into this new model, I call it, which is the life insurance with living benefits. So let's move to countdown number 3. We'll go to the next slide because number 3 on the countdown that every financial advisor must know is Section 79 plans. Now, what are Section 79 plans? This allows you to actually purchase up to $50,000 in group term and be deductible. If you're a code freak, everybody should do that, have at least $50,000 in group term. However, the deduction can actually be larger based on the 1.79 regulations. There's a lot of talk in the advanced underwriting department about whether these are legal or not. I actually had my graduate tax class do research studies every year, and they come to the conclusion that I have. They are legal, and yes, you can do them as long as you do them right. Let's go look at the next slide. Now, Section 79, go to the next slide, Brendan. There are rules, and let's look at these rules in the next slide. You can move it one more. And here's some of the rules. The premium for the personally owned Section 79 is 100% deductible to the company. Well, that's the good news. I own a company, I can deduct it 100%. But here's the thing that you also have to know about. The employees still have to pay a tax on the economic benefit of the death benefit beyond $50,000 based on the Table 2.2 rate. So you have to look at the table and see what economic benefit, and you're going to have to bring that in to your income. Employees also must pay taxes on the permanent cost of the policy as determined by the deemed death benefit formula found in the regulation. And the all permanent cost calculations are based on a safe harbor, fair market value, and it's provided actually in Revenue Procedure 2005-25. So when you're doing Section 79, it's very advisable you work with a third-party administration company that can help you with this and go through the different rules relating to Section 79. Let's go look at the next slide.
We'll go to the next slide, Max. If you wouldn't mind muting your phone when you're not speaking, there seems to be a little bit of feedback coming through. Thanks, Max.
Okay.
Okay, here are some rules for less than 10 employees, okay? You have to establish a C corporation, and the coverage must be offered to all full-time employees with 6 months or more of service, and coverage must be provided as a multiple of income or a flat death benefit amount. All underwriting is based on a non-medical questionnaire. There's a couple insurance companies in the country that sort of specialize in this area. It's a niche market space, but you need to be aware of it. Let's go look at the next slide. One life insurance company, to give you an idea how specialized this market is, can issue up to $2,750,000 of death benefit for doctors and dentists through age 60, up to $2,250,000 for all other occupations through age 60, and $1.5 million for ages 61 to 65 for Section 79 only on a non-medical questionnaire. See how specialized this is? All non-medical underwriting will be issued as a standard with a small commission, flat extra to age 65. So the insurance industry has made it easy for you to actually implement if you decide the client is suitable for a Section 79 plan. Let's go look at the next slide. Rules for 10 or more employees. They have to have a lot of rules. Remember, it's a qualified plan. I mean, not qualified. It's a plan issued by the service regulates. Groups must be comprised of 85% of non-key employees or cover 70% of all full-time employees. Death benefits have to be based on a formula that precludes individual selection, something related to employment, years of service, income, job description. All life insurance applications can also be fully underwritten on the large groups, and they can have a 3-year waiting period for eligibility. So there are different rules relating to Section 79 as they would for a qualified plan. Let's go look at the next slide. Next slide is number 2 on the countdown. And what do we have as number 2 on the countdown? It's private placement life. Now talk about a niche area, private placement life. I was at a presentation in Pinehurst. I live in the Pinehurst, North Carolina area, and they brought on this national presentation, and they had a board of group of people that work in trust companies, and they manage insurance trusts. One manages more than 4,000 insurance trusts. Okay, so I'd ask this question: have you ever come across a private placement life? And the answer was no. They never see them. Okay, but I will tell you what a private placement life is, right? Imagine you have a max-funded non-MEC policy, and you have low mortality costs and expenses, and your sub-accounts are all accounts that you manage. Then you have private placement life. That's basically what it is. Let's go look at the next slide. Most insurance companies, however, have left this private placement life market. There's one insurance company has 40% of the private placement life industry. Right now, the policy does take advantage of the tax-free buildup and tax-free withdrawal of a life insurance contract. Why did they leave it? They didn't see a lot of demand because, frankly, you have the ability to do it yourself inside of a max-funded whole life or universal life contract or an index UL or whole life. So because you have the ability to do it yourself, this never took traction in the what I call the mass market, so the insurance companies basically got out of it. There just weren't enough sales. So most of the people that are in this are usually ultra-high net worth individuals, or frankly, just not a lot of space in this. But I just want to make sure that you know that, remember, this is the top 5 life insurance plans every financial advisor must know. You need to know about it, but you also need to know that it's in a very, very small space, private placement life. So with that, we're going to move on to the next slide, which will be private placement life, which is for serious high net worth individuals, sophisticated high net worth individuals. The ability to have your stock held by your own insurance contract can also be used as an estate planning tool inside an ILIT or an FLP. Let's go look at the next slide. Now, number one on our countdown. What we say is the number one life insurance plan every financial advisor must know. And let's take a look and see what it is.
Okay, if we take a look at this, and what it is, it's a fully insured defined benefit plan. And a lot of folks ask me, well, what are those? Well, fully insured defined benefit plan is a qualified plan. It's like a 401k. All the contributions to the plan are tax deductible and not included in the income of the employees. And there are some additional tax benefits that small businesses might be able to take advantage of. We'll talk about in a minute too. But the plan guarantees lifetime benefits, lifetime income, and lump sum amounts that are guaranteed by a major insurance company. And here's the catch. It also must be a domestic insurance company. And many are going to be also covered under the Pension Benefit Guarantee Agency, which is a federal agency, and that provides guarantees to pension plans. So what this is a very conservative defined benefit plan. They've been around since 1921. And if you go to the next choice, what makes a fully insured plan sometimes a better choice for someone? Well, if you reference Section 430 of the Revenue Service Code, it sets forth the funding rules for a traditional defined benefit plan, and under Section 412(e)(3, it exempts a certain kind of defined benefit plan from the minimum funding rules because the plan benefits, lump sum amounts, lifetime income, death benefits are all guaranteed by an insurance company. So you avoid the issues of overfunding, underfunding that you can run into in a traditional defined benefit plan using stocks and bonds. Now, if you go to the next slide, you'll see that while the assets are in the trust, the funds are generally going to earn a 3% or the crediting rate of the insurance company, whichever is greater. I mean, in today's market, you'll find that it could be as low as 1%, but some are still up to 3%. And in the last, well, since 2000, it's averaged between 3 to 8% in those types of accounts. But this prevents the plan from incurring a loss or facing tax penalties for noncompliance. Now, what do I mean by tax penalties? Just today, we met with a CPA and the client, and it was kind of an interesting conversation because the CPA said, why wouldn't you want to do it a fully, traditional defined benefit plan? And I said, well, what if you had a success problem and had a 16% rate of return? What does that do to, when I asked out of the CPA? Now, this is an interesting point that Nick always brings up, that CPAs tend to not get a lot of training on this field because this CPA kind of displayed that. He says, well, I think that would be, it gets, 16%, you hit a home run, you won. But I said, what if your plan becomes overfunded? Now, what if the next year it lost, like in 2008, over 30% of its value? What happens then? And he goes, there are penalties, aren't there? I said, absolutely there are penalties. And we talked about what those were. And the client, when we finished the discussion, I actually, the CPA, I said, well, why don't you draw on this piece of paper kind of, what happens in the real market in a traditional defined benefit plan, and how does that compare? And when he did that, the client looked at that and said, okay, when it's up here, what does that do for me? And the CPA kind of explained it, and I added a few comments. And when it's down here, what does that do? And the CPA added a few comments. And the client said, wow, why would I want to do that? Why wouldn't I want this other plan that I never have to worry about all that? And the advisor that I was working with said it's kind of like owning a horse. There are those horses that you put in the pasture, and they feed off the pasture all year long, and you take them to the vet once in a while. And then there are those finely tuned race horses that you're constantly taking to the vet, constantly brushing, dealing with. So the difference between these two plans is how much do you want to put in, how much time do you want to put into them. So if you go to the next slide, the next question you typically get is, how much can I fund into a fully insured defined benefit plan? Well, that's where we bring in the action phrase. We have to have the actuaries determine the funding level. The funding level may depend upon their W-2 income, so their income. It will also, be impacted by how they want to structure the plan with employees. They don't necessarily have to include all of them. We'll talk about that a little bit. But the contribution really depends upon age, compensation, the funding time period, and in many cases, the tax-deductible contribution may be as high as $350,000. Now, one of the questions sometimes the insurance advisors ask is, out of that, what typically is in life insurance? Well, again, that could vary. One plan that we were working on earlier today, it'll be down around 23% of contributions. On the other hand, another plan we are looking at discussing with another advisor, the contributions in that plan could be up in the low 40% range. So there's a lot of flexibility that occurs, and each situation has to be addressed individually. Now, under the Pension Protection Act of 2006, we have another added benefit. You can contribute to a 401k plan as well as this defined benefit plan. And many times we do what we call a custom carve-out plan using a 401k and profit-sharing plan as well as the fully insured defined benefit plan. Now, the company can have a 401k, they can have the fully insured defined benefit plan, and they can contribute to both. Eligible employees are in the fully insured plan based upon job classifications. That makes them eligible to participate. Those job classifications have to be reasonable, of course, but they get to participate in those. So, hourly, salaried, physician, shareholder, and they cannot be based upon age or sex, but they can be based on the real job classification. So if you get to the next slide, you'll see that the other question we get is, what are the assets protection benefits of a fully insured plan? Well, first of all, the contributions in the plan are held in a separate trust exempt from creditors. I always use our greatest example of that for those who keep track of the media, like football, would be O.J. Simpson. He's our poster child. O.J. Simpson has millions and millions of dollars of judgments against him, yet at the same time continues to collect his NFL pension. In fact, one of the clients we've worked with out of Montana had a major lawsuit for a real estate transaction he had got into, and I think it was around, Nick, wasn't it about $5 million or so?
The lawsuit was against him was $5 million in Hawaii. He had $1.5 million in his fully insured plan that we were administering, and he asked, well, should I terminate my plan and roll it to an IRA? He wanted to do that. And we said, well, if you do that, now all of a sudden you're limited in terms of your asset protection to $1 million. And he said, stop, hold it, keep it in the pension plan where you have unlimited asset protection. Now, I can tell you this one feature alone, the asset protection nature of a fully insured plan, has attorneys across the country, some of them saying this is the best asset protection vehicle in the country because it's exempt under federal law. One law firm in your area, Max, calls it a 541 trust. And the reason why, it's based on 541 of the Bankruptcy Act, which exempts pensions from creditor claims and lawsuits. And I can tell you this right now, if you're out talking to attorneys or you're out talking to clients who are doctors, lawyers, architects, engineers, you say, well, I have a trust that you can put money into that is exempt from creditor claims, lawsuits. Would you be interested? I can tell you they're all interested, because at the seminar I was in Pinehurst, I found a new statistic. There are now, it's up to 1,340,000 attorneys in the United States, and guess what they're looking for? Litigation. So if you did something wrong, you could lose everything except what's in your pension. And you're right, O.J. Simpson collects his $25,000 a month from his NFL pension because it's exempt from creditor claims. Very, very powerful tool, and it's something that you need to know about it because you can set up a fully insured defined benefit pension plan provided you have a life insurance license. You don't need a securities, but you need to have a life insurance license to set them up. And when you see them set up, Max, what is the average life insurance and annuity contribution to the plans that you've seen?
Well, last year we looked at it. Our average contribution was a little over $180,000 a year, and it was right at 40% of that was in life insurance premium. So pretty much when I've gone back and looked at the last several years, the average life insurance premium is somewhere between $70,000 and $80,000 of that contribution. And that's been pretty consistent for an average. So that's a nice size case that you get to participate in. And the rest goes into an annuity.
Right.
And one thing you have to make sure you do is make sure you have the right products in there, because that's where the catch usually is. Yeah. There are certain products that qualify to go in a fully insured plan, so that's an important piece.
Yeah, and in our area of the world, when somebody's putting in $70,000 in life and $110,000 in annuity, $180,000, in pension world that I work in, we call that a micro pension plan. In other words, it's considered a very small plan, because most pensions that are of any significance, you're putting $1 million or more in. So, but in the fully insured area, I've seen a lot of them, they're putting in $180,000, $200,000. They're considered small pension plans, but for a person who's an insurance producer, a $70,000 life premium should be okay, wouldn't you think, Max?
I would think most of them would get fairly excited about it. In fact, a couple of producers I met with earlier this morning, well, you were on the call with me as well on one of their questions. When we kind of discussed this in their specific case, their eyes kind of lit up as they sat in front of me. Mm-hmm. It's kind of fun to see that, because the case that they presented, I think we figured that they would have made about $47,000. So not that anybody ever does this for commissions. I'm sure that's not the case. No. But sometimes it reads a motivator. And in fact, if you go to the next slide, you can see one of the motivators of the client.
Yeah.
It's taxes. You know, and why is that? It's really simple. Tax rates have gone up. Plus, what a lot of people don't realize is that the PEP and Ps issue, you know, they've lost their personal exemptions. You know, their itemized deductions have been limited. And so those rules and some of the new tax codes and the state taxes as well make these plans more appealing to the client. Yeah. And they make fully funded plans more exciting. So, Nick, you had a comment?
Yeah, one more comment. And this is something, I was talking to people with insurance contract plans versus a 401k that you just need to know about. A fully insured pension plan is more tax efficient than a 401k. And people look at me, well, I thought 401ks were the best out there. No. The problem with a 401k plan is you have to pay Social Security and Medicare taxes on the funds before they go into your plan. So let's say somebody has $100,000 and they're going to contribute into a 401k plan, and they have various different employees that are contributing up to $100,000. They could be hit with 15.3% in Social Security and Medicare taxes, or they lose $15,300. Now you have a group of employees, they're going to put $100,000 in their fully insured defined benefit plan. They get to keep the Social Security and Medicare taxes. There are none. Now it's a very powerful motivating tool if you're working with a group of people that are contributing to 401k and say, why don't we look at a fully insured plan? Well, why would we want to do it? Because you don't pay the Social Security and Medicare taxes. And if you're an owner employee, you know that it's 15.3%. So that savings is significant. It's a powerful advantage you have in the market space with a fully insured plan versus a 401k. More tax efficient because you save on Social Security and Medicare taxes. And when my enrolled actuaries told me about this in 2001, I was going, I never learned this in law school. So I started doing research, and I found out they're right. So guess what type of plan we set up? We set a plan like this, so we didn't have to pay the Social Security and Medicare taxes because they were right. And it's very unfortunate. But in law school, which I went to, there were no pension classes offered unless you went to a graduate tax program. I checked all the MBA programs across the country. Guess what? You could get a Stanford MBA or Harvard MBA, but you never took a retirement plan in class. Same with medical school and dental school. So NAIFA, this is one of the few places which you can go to actually learn about retirement plans. Other than the CFP program, Max, I know that you took, they actually have a retirement plan in classes. But this is a fascinating area, $18.9 trillion in assets, but not a lot of people are working in the pension area. As a matter of fact, in our area, there's maybe 15,000 people, compared to 1,340,000 lawyers. So it's an area of a lot of opportunity if you're willing to sit and you want to wade through the rules and you can help your clients tremendously. They save taxes, and it's a win-win situation for you as well.
Well, and if you look at the tax issue we've talked about, if you go to the next slide, we've got the state tax map.
Right.
And so you look at that, if someone resides in California, that's 13.3, Oregon 9.9. And so when you start combining all these taxes, it gets pretty significant.
Right.
And frankly, taxes are a major motivation for many of our clients that want to get into these plans. Yeah. And some of them are a little smarter, and so they'll move to Nevada after retirement, because by doing that, they deducted the taxes while they lived in Oregon or Utah or Arizona or Idaho as an example. And now they moved to Mesquite, Nevada, a town where I go to play golf on a regular basis, and they avoid the taxes because there's no state taxes as they now take money out of this plan. So it becomes very efficient. In fact, if you go to the next slide, you can see an example with a little comparison we did here. This is an actual case. This was a physician making $493,000. The federal rate was 39.6. The state rate that they lived in was 5%. And you can see a side-by-side comparison. This was a male age 57. So you've got the fully insured on your left, the 401k profit sharing on your right. Left to his own devices, he was going to do the 401k profit sharing plan. But we had the discussion. In this case, his wife was a nurse practitioner. He owned a successful medical practice and didn't have a lot of employees, so this plan worked very well. And we put $210,000. Now, the actuaries, when they calculated, if I remember right, he was eligible for about $238,000, but his budget would allow him $210,000 in contribution. Left to his own devices in the year that he set this up, he could put it in $55,000 in the 401k profit sharing plan. Now, one of the things we found is as we do these, we do a lot of medical practitioners, dentists, doctors, specialty physicians. Why is that? They all fit a profile. They went to school for a long time. They incurred debt going through school. They typically incurred debt getting into a practice. They've now reached their late 40s, early 50s. They're making a significant income. They paid off the bulk of that debt. And all of a sudden they look in the mirror and they either have gray hair or a lack thereof, and look at it and say, you know, gee, I've got $460,000 in my IRAs and 401ks. How am I going to be able to retire when I can only put away $50,000, $60,000 a year? I've got to get a significant rate of return to even have any chance of retiring, so they begin to look for other opportunities. And that's why sometimes we'll see doctors out there who have made some less than educated investment choices because they have lost significant amounts of money in those high-risk investments. Well, here we can be ultra-conservative. We can put a lot of money in, and you can see the comparison here. We put $210,000 in to the 412E3. You can see the tax savings and the taxes that you're paying. And if you get down there on the bottom, the net benefit in this case is a savings of $78,000 over just doing the traditional thing. And you'll see what we lovingly refer to as the Obamacare surcharge or the Affordable Health Care Act, which is 3.8% of the modified adjusted gross income. You've got your payroll taxes, your income taxes, and at the end of the day, the client is $78,000 ahead. And not only is he ahead with taxes, that client now has a significantly greater amount of money in a retirement account for their future, which is what the client wants. And if you go to the next slide, you'll have further justification for talking to doctors, because, you know, according to medical economics, 92% of the physicians in the U.S. should have these plans, and they don't. You know, so, you know, what's the history of these plans? Like we said, approximately 50% or greater of our plans that we do every year are in health-related industries, endodontists, orthopedic surgeons, urologists, etc. And that's the client that usually likes these. Now, we do a lot of these with niche businesses. And really what you kind of have to look at is who qualifies for these plans. Usually it's about 5% of the U.S. population. They generally want income of more than $200,000, and they generally are going to want to put away more than $50,000, $60,000 a year.
Mm-hmm.
Nick, any other thoughts on this fully insured plan?
Yeah, you know, it puzzled me why that there were so few medical professionals that they didn't have these plans. Because in the market space, when we go into it, we find out medical doctors, dentists don't have the plan. And part of the reason why, after researching this area for 14 years, is this. The big actuarial firms, the Mercers, the Bucks, the Towers, Perrin, they told me we're not interested in working with the plan unless they have at least $1 million a year that they're contributing. And most of these physicians are looking to contribute $100,000 or $200,000, but they're not in that $1 million category. So the large actuarial firms, and there aren't that many of them, won't even bother talking to these doctors. Then you think, well, the CPAs will. But Max, you and I know the CPAs don't take pension courses. They don't take retirement planning courses. In fact, it's not even offered unless they go to a graduate tax program, and then that program, it's usually offered perhaps as an elective. Lawyers never take a retirement planning class. Well, now let's look at the medical doctors. They never took a retirement plan class. So if you talk to them about the retirement plan, you might be the first one to talk to them about a pension. They've never even heard of it. And you have such a competitive advantage in the market space because it's even better than the 401k. It's not subject to Social Security or Medicare taxes. Well, I can tell you that. They don't know that. I didn't know that. I was practicing law for 18 years. And our enrolled actuaries had to tell me that. And then I started realizing I don't want to spend 15.3% of every retirement dollar going into Social Security and Medicare taxes when I can have 100% going into our plan that's funded with insurance and annuities. So this is a very powerful plan that you have to know about. Put it in your tool chest. And it's a plan that you can use to help your clients.
Well, one other thing that you should think about, too, is make sure that you have a third-party administrator that knows what they're doing. Mm-hmm. I did my own little survey here a while back and I got on the internet and I looked up third-party administrators that said that they would do defined benefit plans, and I called quite a number of them and questioned them. And what I heard was, well, yeah, we've heard of those. We haven't done one for several years. Or, yeah, we do one or two of those a year. They were not terribly familiar with these plans. There's not a lot of third-party administrators out there. So, and why? I kind of found out why. One is that they're scared of the products that we as insurance advisors use in these plans because they're not very familiar with them. And so they're worried about those. But make sure you have a good third-party administrator involved. You know, one thing I would tell you, too, is don't have this discussion with the CPA in front of the client, because the CPA is going to ask questions that they may feel are stupid questions. They won't ask those in front of the client. And if the CPA can't ask their, quote, stupid questions, then they are going to not ask them, therefore their answer will typically be no. And so the goal is to, typically meet with a client, get permission to meet with their CPA, and then meet with the CPA. I know we participate in a lot of those meetings constantly via GoToMeeting all across the country, and we educate the CPA. Now, there's an advantage, too, if you can get good at educating the CPA. And this literally happened today, or yesterday, rather. The CPA said, this is really appealing. I have a couple of other clients that might be interested in this. How would I get a proposal? And I would assume that most of you out there could help them with that at that point. We'd certainly be willing to help you as well. But that's what comes out of that, because as Nick has said, and we've kind of, beat on a little bit today, they just don't get this. I know that CPAs that come to my continuing ed courses that I provide, they'll tell me, we do not get this in most of our courses that we can take in for CPA CE, their CPA CPE. That is not available to them. So this is a major thing, and you have a real opportunity to educate, CPAs across the country with this program. Now, time for questions. We've got a few minutes.
Yes. We'll
see.
Well, also, how you do the questions. If you go to the bottom right-hand corner, there's a little chat room, and what you do is you type in your question, and then you press one of the buttons, and we should be able to see the chat.
And we do have a number of questions.
We do?
The
Oh,
first
no.
question.
Okay. Oh, no questions. Okay.
I will go ahead and tackle the first question. Can we get a copy of this presentation when it is done? And the answer to that is that the presentation will be archived at www.nafid.org, and you will be receiving an email. All of the participants will receive an email in 2 days, and that email will provide you with the direct web link to access the recorded presentation.
Okay, we can handle that question. Okay, any other questions, Brendan?
Can business owners of an S-Corp use the strategy for themselves?
The answer is yes. As a matter of fact, S-Corps, normally what they do is they distribute out what they call K-1 distributions to avoid the Social Security tax, but they pick up the federal income tax and the state income tax. Instead, they take their normal salary, but then K-1, don't do a K-1, but instead do what they call line 17 or line 23 of the 1120, make a contribution to your retirement plan, and you get the full deduction, and you don't have to pay Social Security, Medicare taxes, state or federal taxes. So yes, C corporations, you can do that. However, one thing you do have to realize, this is an employee benefit plan. So if they have other employees, we have to look to see whether or not we have to bring those employees into the plan with them, or we can exclude them. And there's a lot of different ways you can exclude an employee. They haven't been there for a year, they haven't worked 1,000 hours, they're under age 21, and we don't necessarily have to put them in the pension. We can exclude 60% right off the bat because of 401(a)(26) and keep them in a 401k profit sharing plan. So even if the S corporation has employees, you can still do what we call a carve out if they have employees. They call them DBDC combination carve outs, combo plans. They go by the same, but it's basically the same thing. A code freak like myself says we're using 401(a)(26).
Yep. Next
Thank
question.
you.
Next
Yes,
question.
And there's a follow-up, which I believe you've answered, Nick,
Sure.
which is "and not include employees?" question mark. So I think we've trotted over that.
Yeah,
territory.
you're going to have, remember this is an employee benefit plan, so you're going to have to look at the data from the employees to see whether or not we have to include them or not. Another little tool you can do is you can do a 2-year eligibility. So if you have an employee that's not there for 2 years, they don't go into plan. So there's little things that you can do that are inside the code that we might be able to help you make that a good case.
Great.
Well, and one thing I might add is it's really important to take a look at the census, the age of the employees, the compensation, all those things, and family member involvement, and who's highly comped and who's not, because the design factors in this are very, very critical, and it is not unusual that we can design these plans so that 89, 90, 95% of all contributions are going into that plan for the professional or business owner too.
Right.
Excellent. We do have another question,
Okay.
and the question is simply, is it true for California? So I'm going to ask the asker of that question about California to go ahead and ask a follow-up question as to specifically is what true for California, and I promise we'll go ahead and get to your question as soon as we get that.
Yeah.
The next question, isn't this 412E3 plan, doesn't it need a third party to administer? Please explain.
Well, good question. Okay, it's like saying, do I need a lawyer to go to court? Well, probably a good idea. When I was actually practicing near estate planning, when I came into pensions, I always used a third-party administrator. The reason why you don't legally do you have to? No, you don't have to. But should you? Yes. And here's the reason why. These rules change all the time. In other words, what we're telling you today can change within 30 to 60 days. Okay, if you're not daily on top of it or have a staff that's daily on top of the qualified plan area, your plan quickly goes out of compliance. 2 years ago, the service dropped on us called the 436A amendment. I'm sitting there going, are you kidding me? They gave the TPAs like 30 days to put up an amendment on all their documents or the plan goes out of compliance. So I would not suggest or recommend somebody try to do these on their own, because they're going to have their rear handed to them because it's a daily task. ERISA is a jealous mistress, okay? You're either working in ERISA, doing it full time, and this is all you're doing, or you're going to end up in a lot of trouble. Every day we check the boards for the rules that change from the Department of Labor, which, by the way, did issue a new proposed rule recently, which got a lot of traction. The Pension Benefit Guaranty Corporation, which Max told you about, and the Internal Revenue Service. So we have to monitor the boards daily for rule changes in these three areas. Highly recommend work with a TPA, a good third-party administrator, if you're going to get involved in fully insured defined benefit plans.
Next question, does the policy have to be surrendered at retirement?
Yes, I'll pass that one on to you, Max.
Okay. The policy doesn't necessarily have to be surrendered at retirement. Now, practically 80–90% of them do. And in reality, though, we do have some clients, because of health issues, they get to retirement, they don't want that. There are a couple of companies out there that will allow a net amount at risk conversion, meaning that they will take the net amount at risk. So if you had $1.3 million in cash value on a $2.7 million policy, they would basically allow you to take a $1.4 million in a net amount at risk conversion to a policy outside and surrender the balance for the cash value inside the qualified plan. So different companies have different rules on that, and depending upon what you want in terms of flexibility, that's an important thing to look back at. But practically a lot do. So you do want to use those higher cash value whole life contracts. You cannot use UL contracts or UL chassis contracts in these plans.
Right.
And you do have to make sure that they have contracts that will qualify in a pension plan.
And what Max said is very important. These plans must be funded with a whole life and must be funded with a fixed annuity. In some cases, you use equity index annuities, but you can't use universal life products in these. Has to be a whole life product for the life side, preferably a high cash value whole life, and also must be a fixed annuity product in there. So no variable contracts go into these plans.
Yep.
With the fully defined benefit plan, are the death benefits tax-free?
They can be, okay? If the person, what they do is they adjust the deduction downwards a little bit to include what is known as PS 58 or now Table 2001 rates, then the death benefit, net amount at risk, can go actually tax-free at death to the surviving spouse. If you don't do the inclusion and the reduction or inclusion of the PS 58 amounts, then the death benefits actually come taxable in the form of an annuity. So you can go either way in your plan design if they want the death benefits tax-free or they want it taxable.
And we have a follow-up question concerning the law in California. The questioner was asking about creditors specifically.
Sure. Good question. By the way, these questions have all been good, but good question. It's federal law that exempts these assets from creditors, not state law. So because under 541 of the Bankruptcy Act, federal preemption in ERISA generally, okay, that what happens is federal law protects them and it doesn't matter what California law says. If you go look at a lot of cases regarding ERISA, this is a federal mandated landscape. So California could say we don't exempt them, we do. The federal government doesn't care, and under federal law they're exempt from creditor claims. So the state may have their own exemption, or they may not, but it's irrelevant today because of the federal law that under 541 of the Bankruptcy Act, which exempts these from creditor claims.
We are running out of time, and we have a large number of questions. We're going to finish up with a couple more. What data do we need to get a proposal together?
You go to our website, and we actually have, at nationalpensions.com, we actually have request for proposals. You press the button, and it has the data that you need to fill out. It's all on the website.
Okay, and I'm going to ask two more questions, which are both interrelated. Is national pensions available for joint work for a case or two to help us get our feet wet, so to say? Or would you prefer a longer-term relationship? And then the other similar question, does the agent split cases with your firm, or do you own an override?
We kind of do both. We do almost all the cases we do on a joint basis. We do them via go-to-meeting, so we do them all over the country. This morning we did a go-to-meeting with one, and we are constantly doing that, and we really recommend it. We have found that if we are involved in the case, we are closing 60 to 70% of the viable cases. Mm-hmm. If we are not involved in the case, the closing ratio goes down to about 5%. Right. It drops dramatically. Some of it is Nick is a wealth of knowledge. Between Nick and I, we've done about 450 of these plans over the years. We usually don't get stumped. Is that a fair statement, Nick?
That would be a fair statement. You're right. We've done over 450 of these. I've actually defended successfully more than a dozen audits. I hate defending audits. I'm not going to say I love that work, but it's been really really good. And I've also seen a lot of clients retire off these plans that because they were guaranteed when the market crashed, our plans went up 3%. So we provide a very valuable, stable service for the people that do them. And Max is right. We do a lot of joint work. Most of our work is joint work through the internet in a go-to-meeting format like you're seeing right now with the client and the client's CPA or tax advisor, and making sure that we're doing a good job for the client. Number one, make sure we do a good job for the client. And then number two, our producers are very pleased with the type of work that we do for them as well.
And we will work with you, the individual producers, to determine the best way for them to work with us. Mm-hmm. So that's not a one-size-fits-all answer. We have different companies and different producers that we work with in different arrangements based on what is best for their individual scenario.
Yeah, and we have contact information right there on this page. So I'm on the internet almost 24/7 answering questions. So just email us and we'll be more than happy to help you with whatever case you have, or if we look through it and we say, look, this is not a good prospect, we'll let you know that too as well.
Well, we do have a number of other questions, but unfortunately we are out of time. I would be happy to email those questions over to Max and Nick.
Yeah, we do.
Thank you, gentlemen, very much for that.
No problem.
I want to thank Max and Nick for an outstanding presentation. To access today's presentation, please do use the web link that will be provided to you in the automated follow-up email. And thank you to all the NAIFA members who joined us today. And this concludes the NAIFA webinar.
Have a great day, everyone.
Thank you, NAIFA. All right, take care. Bye-bye.